In just 47 days, 37.6 million ounces of physical silver vanished from official inventories. That's more silver than many countries consume in an entire year. More than entire industrial supply chains depend on in a single quarter. And almost no one noticed. No emergency meetings. No trading halts. No headlines warning of shortages. Yet this wasn't paper silver. It wasn't a futures contract rolled over or an ETF quietly rebalanced. It was physical metal, bars with serial numbers, audited locations, and delivery obligations, removed from the system that underpins global silver trading. That contradiction is the story. Silver isn't obscure. It's one of the most closely monitored commodities in the world. Inventory data is published daily. Large movements are supposed to be visible. So when tens of millions of ounces leave in less than 2 months, and prices barely react, the question isn't what happened. It's what absorbed the shock. Global silver mine production averages roughly 820 to 850 million ounces per year. Industrial demand alone consumes more than half of that. There is no massive surplus. No hidden stockpile waiting in reserve. Which means movements of this size don't disappear into noise. They shift pressure. And pressure that doesn't appear in price usually shows up somewhere else. In access, delivery, and trust. Once physical silver leaves official inventories, it doesn't circulate freely. It moves into vaults, factories, or sovereign stockpiles, often with no intention of returning at current prices. Whoever did this wasn't reacting. They weren't speculating. They were positioning. And the most unsettling part isn't the number. It isn't the speed. It's the silence. Because if this was a warning signal, it wasn't meant for the public. It was visible only to those watching inventory flows, not headlines. And by the time most people notice price, the metal is already gone. To understand why this matters, you first have to understand where that silver was supposed to be. Most people think silver trades like stocks, numbers moving on a screen. But behind every trade is a physical system built on vaults, classifications, and delivery promises. That system works only if the metal stays where the market says it is. At the core are exchange-monitored vaults, reporting inventory levels daily. But not all silver inside those vaults serves the same function. There are 2 categories. Eligible silver meets exchange standards but is not committed to delivery. It belongs to someone it's stored, but it is not backing active contracts. Then there's registered silver. Registered silver is the critical layer. It's the metal explicitly available to meet delivery obligations. It's what turns paper contracts into something credible. Think of registered inventory as the market's buffer. You don't think about it when it's full. But once it starts shrinking, everything downstream becomes fragile. Under normal conditions, inventories fluctuate modestly. Deposits and withdrawals balance over time. When major drawdowns occur, they usually coincide with visible stress, price spikes, delivery delays, or public concern. That didn't happen here. This wasn't a single abnormal day. It wasn't reporting noise. It was a sustained multi-week drain. And once silver leaves reported inventories, it no longer stabilizes the system. It no longer reassures markets that delivery can be met. It no longer cushions demand spikes. This is why inventory data often matters before price moves. Price is reactive. Inventory is structural. Historically, when registered inventories fall too far, too fast, markets don't adjust smoothly. Premiums rise. Spreads widen. Delivery terms tighten. Not because silver has vanished globally, but because it's no longer available where it's contractually expected to be. When silver leaves this layer of the market, it's not just supply that's reduced, it's confidence. So when 37.6 million ounces leave in 47 days, it signals something very specific. Someone chose certainty of possession over liquidity, over yield, over paper exposure. And that choice narrows the field of possible actors dramatically. But before we ask who, we need to understand how this drain unfolded. Because the timeline tells you whether this was chaos or design. What makes this event unsettling isn't just the total. It's the pattern. This wasn't a single dramatic withdrawal. It was gradual. controlled, almost methodical. In the opening days, the numbers looked ordinary. Hundreds of thousands of ounces, sometimes a million. The kind of movement that blends into daily reporting noise. Then the pace changed. Within about a week, withdrawals became more frequent, larger. Deposits slowed. Net outflows became consistent. By the second phase, there was no ambiguity. Silver wasn't circulating. It was exiting. Day after day, inventories declined, not violently, not chaotically, but persistently. Like pressure being released through a valve opened just enough to avoid alarm. This matters because markets respond to shocks, not slow compression. Sudden collapses trigger reactions. Steady drawdowns slip through unnoticed. As weeks passed, withdrawals clustered into larger blocks. Multi-million-ounce weeks became routine. And still, prices stayed calm. That mismatch is the signal. A chaotic market leaves fingerprints. This one didn't. Random behavior produces noise. Strategic behavior produces consistency. By the final stretch, cumulative withdrawals crossed a psychological threshold. Tens of millions of ounces removed from visibility. The system was operating with a materially thinner physical buffer. And yet, on the surface, everything looked fine. This is where risk is often misread. Many assume the danger ends when the metal leaves. In reality, it begins afterward. Because inventories don't exist for today's trades. They exist for tomorrow's obligations. Every ounce removed reduces flexibility, reduces margin for error, and compresses the time available to respond. Which leads to the unavoidable question. If this wasn't random, if it wasn't retail, if it wasn't panic, then who could remove this much silver, and why? At this scale, possibilities collapse quickly. 37.6 million ounces is not something you accumulate accidentally. It immediately rules out retail investors and fragmented demand. Coin shops and individual investors operate in thousands, not tens of millions. Even during extreme periods, retail does not coordinate direct withdrawals from exchange vaults. So retail is out. Next, traditional investment funds. Most large funds prioritize liquidity. They prefer exposure without storage, logistics, or security risk. Physical delivery at this scale makes sense only if you expect stress inside the paper market itself. That narrows the field. Now consider industrial demand. Silver is essential to electronics, solar panels, medical devices, and advanced manufacturing. But industrial buyers secure supply through long-term contracts. Their withdrawals are predictable and tied to production schedules. This was neither predictable nor smooth, which leaves only a few realistic candidates. Large industrial users accelerating stockpiles, sovereign or state-aligned entities, or financial actors deliberately converting paper exposure into physical metal. All three point to the same motive: risk management. Here's the key detail. When someone chooses physical possession over rolling contracts, they're signaling a preference. Not panic, but distrust. Preference for ownership over promise. And price behavior reinforces this. If demand were speculative or driven by urgency, price would likely reflect it. But it didn't. That implies discipline, patience, intent. The objective wasn't profit. It was insulation. Insulation from delivery risk, from counterparty risk, from system stress. And once that mindset takes hold, it doesn't reverse quickly. Which brings us to what the market isn't saying out loud. Markets don't lie, but they do withhold. They show prices and volume. What they rarely show is strain. On paper, silver looks abundant. Daily trading volumes dwarf physical supply. Futures open and close instantly. Access appears unlimited. But that abundance exists only because most participants never ask for delivery. The system works only as long as that assumption holds. When physical metal leaves inventories, the paper market doesn't fail immediately. Instead, leverage increases quietly. More claims per ounce. More dependence on coordination and confidence. This creates a paradox. The calmer prices appear, the more stress can be building underneath. Historically, disruptions don't begin with price explosions. They begin with shrinking buffers, longer delivery timelines, and rising physical premiums that futures charts don't fully capture. By the time price reacts, the metal is already gone. Paper markets can function longer than people expect, right up until the moment they can't. When stress finally emerges, it doesn't arrive gradually. It arrives triggered by a catalyst, a demand surge, a geopolitical shock, or a loss of trust. At that point, the question changes instantly. Not, what is silver trading at? But, who can actually get it? Inventory data is public, but rarely emphasized. It doesn't trend. It doesn't generate clicks. Yet it quietly signals when the foundation is thinning. Which brings us to the final perspective. This isn't just about silver. Silver sits at the intersection of multiple global transitions. Energy systems are being rebuilt. Solar infrastructure and electrification require silver in non-trivial quantities. At the same time, mine supply growth is constrained. New projects take years. Recycling cannot scale fast enough. Layer onto that geopolitical fragmentation. Strategic resources are being stockpiled. Nations increasingly prioritize resilience over efficiency. Then overlay financial stress. Global debt levels are historic. Trust in paper promises depends more on confidence than backing. In that environment, converting claims into assets with no counterparty risk becomes rational. That's where silver fits. When physical silver leaves official inventories, it reflects a decision to step outside the system's assurances. Ownership over access. Certainty over convenience. This is how transitions begin, not with announcements, but with positioning. Prices may remain calm. Commentary may dismiss inventory movements as technical. But history shows that structural shifts reveal themselves quietly. By the time consensus changes, the metal is already spoken for. So the significance of those 37.6 million ounces isn't just that they're gone. It's that they were taken before panic, before headlines, before consensus shifted. That's how informed actors move. Because markets don't break when everyone is watching. They break when the inventory is already gone. And no one can get it back. If you want more analysis like this, focused on data, structure, and what markets signal before headlines catch up, consider subscribing to the channel. Because by the time something becomes obvious, the most important move has already been made.